You are not an investor when you trade stocks. You are a gambler. Okay? It used to be that if you wanted to gamble, you had to drive to Las Vegas. Okay? Now you don't need to do that. You can just drive anywhere around here. There's a casino somewhere around where you can go gamble. Okay? So for a lot of people who needed that gambling fix and didn't want to drive to Las Vegas, they started trading stocks. In and out, in and out, in and out. And it became a pretty dangerous situation. A study was done that says only about 11% of people who trade stocks make money. Okay? Those are not good odds, not good odds. But let me tell you how important it is to have a much different perspective about the stock market, and that's staying in the game. This is a report from Franklin Templeton, and it talks about a period of time, a 20-year period that ended at the beginning of 2012, okay? And during that 20-year period of time, the stock market, as measured by the S&P 500, averaged an annual return of about 7.8%, a little bit more than 7.8%. That's not a bad rate of return. That's what the stock market historically does. For my own personal portfolio, I shoot every year for an 8% return, okay? 8% is very good. All right, here's the rub in here, okay? What happens if you start trading, okay? If you miss, and by the way, in that 20-year period of time, there are about 5,000 days that the stock market is open, okay? I didn't calculate it out to the exact number, but it works out to around 5,000 days. If you miss the best 10 days, out of those 5,000 days, if you missed the best 10 because you were away from the market, okay, your return drops from 7.8% to 4.1%. Okay, that's 10 days out of 5,000. If you miss those 10 days, you're really going to get hurt. If you miss the best 30 days out of those 5,000 days, your return goes from 7.8% to a negative 0.4%. It's real simple. It's time, not timing, that makes for great investments. And come up with an idea of what you want your money to do. If it's the stock market, then do it. Find a good way to do it. Index funds, whatever is appropriate for you, and just stay with it. Put the blinders on, forget about the noise, and just keep going, based upon your own tolerance for risk. And I understand clearly that everybody in this room has a different tolerance for risk. So you have to do what's right. I speak to a lot of senior groups, and I'll get into my spiel about long-term investing, and somebody will raise their hand and they go, hey, Chamberlain, I don't even buy green bananas, buddy. Don't talk to me about long-term investing, okay? So, you know, everybody's different, and there's probably people in the room saying, Chamberlain, the bus for Viejas leaves at 7 o'clock. Let's keep it moving, okay? Let's keep it moving. So you have to know what your tolerance is for risk and then make appropriate investments. And don't apologize to anybody. Don't feel embarrassed if the stock market is just too risky for you. That's absolutely fine. That's absolutely fine. It's more important that you be able to sleep at night than you get a big return on your money. You have to do what allows you to sleep at night. That's what I think is most important. But it just shows you that if you're in the stock market, if you mess around, if you say, gee, the stock market's had a great run in here. How many new highs have we hit in the last month? Don't you think maybe it's time to step away? No, probably not. Probably not. And even if you do, if you're on a program like your 401k or just something that you use on your own discipline where you're investing automatically every month, there's a number of ways to do that, again, through retirement plans or other types of things. You might even enjoy a little bit when the stock market goes down, because you're able to buy more of whatever you've been buying on a monthly or quarterly basis. You get to buy more of it because the price of that stock or that mutual fund has come down.